Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. The case for a chat today, as we are wedged between a rate easing cycle decision by the US Fed and the US elections, is this on your screen. Will rate cuts bring in flows to emerging markets and India? Is India expensive for a 10% downside? Because that is what a lot of people fear. And within sectors, are private banks, the largest and arguably one of the cheapest large sectors, poised for upsides over the course of the next 12 months? That and more with our guest on Talking Point today, Vikash Kumar Jain of CLSA. Vikash, so good having you. Thanks for taking the time out. I hope all is well.
All is well, Neeraj. Thanks for having me.
The pleasure is always ours. Vikash, I want to start off with this. How do you see what happens to emerging markets in India in the wake of a rate easing cycle? Because if we look at the past history and enough number of times and enough ways this can be dissected about what happens to markets over the next 12 to 24 months, the view isn't quite clear.
Sure. I think the view isn't clear because we're just focusing on the action of rate cut rather than the reason why the rate cuts were done historically. So that's where it is important to understand why the rate cuts are happening. Soft landings, which the market is talking about right now, are actually rare. That's something which has happened only a couple of times in over 100 years of history for the US. That's why many previous rate cuts have not followed up with great market action. So I think rather than following what happens after the rate cut, we need to focus on the reasons why the rate cuts are happening. If I think at this juncture, at least the equity markets have taken a comprehensive and a convincing view that we are getting into a soft landing. That's not how commodity markets are convinced. And there are differences over there. Since, I'm not trying to draw a parallel to 2008, but since that's something which is more recent in memories of many of us, sometime in the fall of 2007 as well, we were arguing, that there could be a soft landing, I think. And what happened in 2008 wasn't really the prettiest of pictures. What we need to appreciate is many a times rate actions take time to play through into the economy. And that's the bit that markets, many of us in the markets aren't really that patient. And if a particular rate hike or a rate cut or a lack of one has not led to any significant change in the near-term economic picture, we start thinking that, more or less we've digested all of that. That may not be completely true. So that's why I think the jury is still out. However, what we need to, the way we typically, my personal way of looking at markets is to try and predict how narratives will move rather than predicting the eventual outcome of things, because the eventual outcome at times is something which takes much longer for us to figure out with a lot of accuracy. So it's important how narratives move when trying to position portfolios as well. And that is where I believe yesterday's consumer sentiment data point that came out of the US wasn't really the best one. I would say come the Friday after this one, we will have the jobs numbers and the employment number. That's going to be very crucial. I think the focus now shifts away from inflation and shifts more towards some of these metrics which measure the health of the economy. If employment falls in a more dramatic way over the next couple of readings, then that's where suddenly rate cuts per se will not be seen as exciting, but will be seen as more necessary. And, so that's the bit that we need to keep thinking about. So I would say those first Friday of every month, the job reports that come out, that become far more important over the next few months and could be one of the days which can cause a lot of volatility. So that's something that we need to watch out for.
Okay. Well, the reason ascribed could be an important determinant as well, as Vikash is saying. The question though is that Because the question, of course, is that one, because it's a mug's game trying to identify what the markets could do. I'm not saying you guys do that, Vikas. It's a job compulsion to give out targets. So you're, of course, doing it very well over a 12-month period. But I mean, over a 15 or a 30-day period, I would presume it's a bit of a mug's game to try and do that. My question, though, is what might be a lot more informed opinion from you for us would be, what is it that you reckon could happen to flows? And what is it that you're gauging from your clients about flows into India now that the easing cycle has started? Is there a one-to-one correlation between an easing cycle and flows into India? And if not, what are the nuances this time around for inflows into India?
I think that's a very relevant question, more so in the last quarter of this calendar year. Those flows will be very important because we get into, I would say, a pretty big period of supply coming in equity markets as well. So that's where more FII inflows will be required. However, can that be taken for granted? We do not know. See, if there is a rate cut and this narrative of soft landing continues, then we can be hopeful of more inflows into EM market. However, if this narrative of soft landing comes under a bit of doubt, even under a rate cut, an investor sitting in the developed world would not feel comfortable putting money in a more risky asset class. That's how they would view emerging markets as. Then there will be no such major incremental inflows. Why those two scenarios are very, very important is to add to all of this, what makes this whole cocktail even more interesting is what China has been doing over the last few days. Although I have to say, whatever feedback I've been getting with my global colleagues, they believe in the action taken by the Chinese authorities in terms of being able to cause a more sustainable rally is still very low. However, if there is a rally in the Chinese markets and we do not see a lot of incremental inflows coming into EMs, then there's going to be allocation away from India just to chase that rally, because it's become a consensus underweight China. So that's the other thing that we need to kind of bear in mind to bring all of this to make more sense to what is happening closer home in India. We head into a period where there's going to be a big race in terms of supply that we will see for this quarter, if you were to believe many of these media reports and many of these upcoming IPOs and other fundraisers, if they were to be successful. I think the number that we are looking at is about $7 billion of total IPO that has been raised, only IPOs, so far in the first 9 months of this calendar year. The number that could come in could be much more than that in the last 3 months itself. So there is definitely a requirement of more inflows into India, because if that does not happen, then a lot of the foreigners who are interested in these IPOs may simply sell out of the secondary market and invest there. So clearly, that could cause some nervousness in the already listed secondary market space. So in fact, like for example, last month, the month of August, where we saw a pretty big increase in weight of India. Despite that, the total FII inflow was only about a little over $1 billion in that month. Now, where that came from, there was a very big buying by non-India dedicated passive money that came into India, but a large part of that buying was from non-India dedicated active sellers. In fact, although there was over $1 billion of inflow in the month of August, more than that went into the primary market. So secondary market actually saw a small outflow for foreigners. So that is where I think getting this incremental flows from an FII flow perspective will be even more important than any of the last few months, because we are likely to see a very big, supply coming, very, very big demand for new IPOs coming into the market in the last quarter.
Vikash, it's an interesting point that you raised, because when I did, and and correct me if I'm wrong, of course, but when I looked at the last 12 to 18 months, I thought the foreign participation has been pretty decent in the primary markets, if you will. And primary market subscriptions have looked very, very robust. I mean, we just closed the small IPO, of course, but that got subscribed 224 times. Another one which is open, again, a smaller one, subscribed 24 times on day one. It's quite strong, this appetite for primary paper. One, is it desirable? Because if there is no primary paper, then liquidity can take the markets to bubble territory. And two, does it worry you, or is it okay that with the kind of liquidity sloshing around, you will get oversubscription, but why should that be a problem? Because the stocks will eventually list and do what the earnings determine them to do, right?
So see, okay, so what I was trying to say was more about the impact of that offering supply on secondary market.
Yeah,
Okay.
yeah.
But I think there is a need. There is still a section of futuristic industries which are not very well represented in our benchmark. I would say if you were to compare the top 10 constituents of Nifty over the last 10 to 15 years or even little longer, most of them have stayed constant. That's not the case if you were to look at many other large economies, because many of new age kind of companies, whether you look at the US, whether you look at even China, many of these tech companies and some of these other companies are now better represented in the market. So whether this is something which is which I'm worried about, not really. I mean, from a longer term perspective, it's desirable that the index, the primary index of the primary market and the index of the country is more representative of where the growth is expected to come from. So I think that's desirable. From a shorter term perspective, what you need to appreciate is the rush towards primary offerings is also to do with the fact of that there is a significant lack of ideas that we are facing in the secondary market.
Yeah.
And to generate alpha is very, very difficult. To get an upfront discount and a large allocation in one of these things, although that's difficult, but to try and get that is what institutional investors are after, because that's where a lot of the alpha for many of the listed funds have come from.
But Vikas, sorry, may I just ask? I can understand if the nature of the paper that would have come in would have been of a completely different nature. Like, I mean, I'm just saying, for example, if Zomato's got subscribed with an IPO today in a massive fashion, because it's just a differentiated business model, a lot of companies which are getting subscribed are not really, I mean, for lack of a better word, differentiated. There are parallels existing with proven records in the secondary markets as well. And it's not that the primary card paper is coming at a very high discount, right? So then why? Or is your opinion different?
No, I do not differ over there. See, I think what you need to appreciate, I think we are also at a point where if you talk to many people privately, it's the kind of valuations that you're able to get in public markets are perhaps even better than what you're getting in private markets. So there is obviously a rush to invest and to raise money in public markets. In that process, see, we can't regulate all of these things. It is, it's not for you and me or anybody to ration that. That's the beauty of how capitalism works. And in this process, of course, there's going to be some disappointment, some failures. If you look through, for most sectors, if we look at valuations for those sectors in India and for those same sectors across the world, in most cases, I won't be surprised to find that India is the most expensive, valuation, not just as an overall market, but across sectors, sector by sector. Like an Indian consumer company would be the most expensive in the world. I would say Indian tech companies could be nearly the most expensive in the world. So those are things that what that does is clearly a way in which you kind of try and monetize that thing. Eventually, a market like what we are in at this point of time will possibly supply is what will bring it down, because unlike many other previous, if you were to look at history and the history of large corrections that have come in global markets, that have typically coincided with something wrong happening with the economy. If you were to look at EMs, then discipline going haywire of some kind of deficits getting created, leverage being there. Those worries are not there in India right now. That's the good part. Most of the worries that we have are more to do with excitement in the equity markets and perhaps that excitement getting frothy or not frothy and those parts. See, this is likely, if it's an equity market problem, it will be solved by or if it's an equity market excitement, a problem will be created in equity market, and that problem might very well come from supply. And it could pretty much, how it could come if there is too much supply, and at the same point of time, supply comes at a time when foreigners are not able to plow in a lot of incremental money, but simply take out money from secondary market and reassess that. So that's where some of this could happen.
Are your clients telling you that? I mean, because for example, we were at one of the other investor conferences of your peer groups, and there the conversation seemed to be that people are actually looking for avenues to invest into India. They recognize that some parts of India is expensive, but they still want a piece of India. What are your clients telling you?
So I would say the discussion needs to move in terms of when you put horizons in perspective. What you're saying is absolutely true. And so we had our Big Asia Forum in Hong Kong very recently, and where we possibly end up getting almost 2,000 investors over there. Very, very busy conference, very well attended, possibly one of the most popular Asia conferences. What I could sense was clearly a massive a massive liking for India. However, that does not translate into immediate flows because people are not comfortable with valuations. Okay. So I think the way I will read that is the two things that I said. Firstly, there's a massive liking amongst foreigners for India. Secondly, at the same point of time, we don't really have an economic problem. We only have a stock market. Both of those things mean that if there is a stock market problem leading to a pullback, perhaps the pullback will not be deep enough. It will be a relatively shallow pullback rather than a 40-50% correction, which we typically think of a bear market. It will not be that much.
Got it.
Because the longer term story is still pretty powerful.
Pretty powerful. That's true. Vikash, you made a point about how representation of sectors or themes which are not well represented should be there, those which get earnings growth, etc. This whole new age tech sector that has gotten formed, what is your view here? Because, for example, I read a note which had a very nice tagline from your house, which said, are you talking about an urban slowdown? Ask Diljit and Coldplay, or something like that, right? So, very nicely written note there. But my question is this: what's your view on the Zomatos, PB Fintechs, and this whole tech-enabled sectors, which are probably promising mercurial growth? Will they have higher representation on the benchmark indices, the Nifty and the Sensex too? Could they be multiple times what they are right now in size?
See, I think those two are easier to answer yes to both of them. Yes, there will be multiple size of that. And will they have a higher representation? Absolutely. However, I would avoid taking a broad brush approach to things called tech. In fact, we as a house do not do that. We don't really cover things like tech. We appreciate that tech at times is just another distribution channel. The cores of many parts of the businesses do not kind of, are still there. So we don't really cover it as a tech sector. We cover it based on the core offerings that sector has. So like I think the kind of report that you mentioned would be consumer tech and covered by some of these quick commerce companies and all of that. But the others that you mentioned about is more around fintech, that'll be covered with the finance team. So I would say you need to look at things. There is some amount of tech which is going to be there across most businesses. So we should not really be misusing the word tech. However, there are certain themes where if they are genuinely solving a problem and there is a clear case for them to grow the business and the industry, I think those things are there. I would say quick commerce possibly is one of that spaces where we actually had a very, very nicely detailed report called Abracadabra. So I think that's something which is the other one that you should take a look at. But clearly, there are areas where things are much more promising than the others, and that's where one needs to differentiate. I'm not in the camp. Yes, in a bull market, you try and use a broad brush approach, but that's where eventually survivability and sustainability will be measured. To do that hard work, to appreciate where a more sustainable business model will be, and which is going to continue growing.
Want to do a small conversation, Vikash, with you on the one thing that's actually started to move a little now, but had baffled people for such a long time as to what to do with banks, private sector banks in particular, laid low for such a long time. And sure, I mean, the growth numbers were a bit off, and each of the large 5 private sector banks had idiosyncratic issues too. But do you reckon that the next 12 to 18 months, if the markets have to do well, then banks will be key participants?
See, I think the 12 to 18 months bit is not always easy to guess, because I think they're definitely facing some challenges in the near term. But if you look at a slightly longer term perspective, and many investors who are investing in India are trying to play the long term story, the fact that it could continue for a few more, clearly many more years, it is going to be difficult for banks to not do well if the overall economic growth thesis that we are talking about kind of really plays out. For them to have credit growth closer to what nominal GDP is something which is not difficult to imagine. Yes, there are some near-term worries that have got created. I think for people who have a slightly longer-term horizon, more like a 3-year kind of an horizon, this is one place where there is still possibility of re-rating of multiples. And at times, market has this ability and a willingness to extrapolate the near term. And it could do that at good times, it could do that at bad times. I think for banks, it is happening on the reverse, and that's where the normalization of and that dawning of reality, whenever that happens, could lead to some improvement in the way people look at it. So from a slightly longer term perspective, yes, this is one of the few spaces, very few spaces, where I still see room for a potential re-rating, which could be possible on a slightly more medium term perspective.
Got it. And would it be restricted to large private banks, or do you believe SOE banks could also feature in that list, Vikash?
I would say the re-rating in the SOE banks has already happened, and that's pretty visible. It is the large private sector banks that I'm particularly referring.
Okay. One last question, Vikash, and again, just broadening it out. There's a Bloomberg story which says that buy ratings are vanishing in India's overheated market. Now, I mean, it's a very, I won't say hyperbolistic headline, but something which is really pumping up the issue. But my question really is that at your house too, do you sense that the number of stocks on which you can comfortably give a buy call is a lot lower right now than what it was maybe 12 months ago?
Absolutely. I mean, that's something that we've been talking about for the last 2-3 quarters as well. We've seen a couple of quarters where a pretty big chunk of companies, say more companies have seen upgrades as compared to downgrades in terms of estimates, in terms of earnings estimates. Mm-hmm. However, analysts, when they were taking action on price target and recommendation, there were far more downgrade in recommendation than upgrade. I think we are dealing with a unique situation for a few, because a few things have changed. We are used to a period where the marginal stock price was determined by FIIs. And those FIIs used to compare valuations in India versus valuations elsewhere. That has fundamentally changed for now. The marginal price is being determined by domestic investors. And these domestic investors, in most cases, have only one market to invest. They do not really compare valuations with what is happening in another market on a regular basis. So I think just the fact that India is more expensive, or it is more expensive versus history, is typically the way analysts look at things. And there could be these short-term periods where that is not a good gauge to give you short-term performance. And perhaps we are in that short-term period where more fundamental analysts, and I myself am one looking at a particular sector, but it is going to be difficult when you look at some of those benchmarks. But such periods do not last for many, many years. They do last a few months, and they could last a year or two. That is going to be challenging, because eventually things, uh, people will follow the money. You can already see uh, foreign companies trying to list into India. So there are things that will happen to kind of normalize this big arbitrage that is existing. So, but in the very short term, this thing can continue for a while. And that's where the challenge comes in, because uh, many analysts would look at history or look at peer base and think that this is not straightforward. And that's where the struggle will continue.
Most certainly, Vikash. Great having you. Thanks so much for taking the time out and joining us and giving us your perspective. Maybe if the festive season is too soon, then closer to the year end, or maybe once the new calendar begins, would love to do a conversation. But thanks for joining in today.
Thank you. Thanks for having me.
That's the CLSA view, and that's all the time that we have on this edition of Talking Point. Thanks so much for watching.